The views and opinions of this program are those of the hosts, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Well, there has been a lot of talk about yield estimates and more over the last several weeks, but now we're starting to get updated yield estimates, and the prevailing theme is that it is going to be a large corn crop here in the U.S. What does that mean for these markets? We're going to take a look at Tuesday's trade action and get some perspective here today. Joining us for a conversation, it's always great to talk with Jim McCormick from agmarket.net. Jim, how are you, buddy? It has been too long. Great to have you back on the show with us.
Thanks for having me on, Jesse. I'm doing well. I got to tell you, I'm out of Northern Illinois. Just outside of Chicago is actually where our studio is. Where I live is about 5 miles off of the Wisconsin border. And I got to tell you, in general, the crops look good. We are getting some of that fire smoke from Canada kind of filtering through. But right now, here, at least in Northern Illinois, where I'm at, it does look like a bumper crop is definitely on the way.
Let's talk about this. It's the elephant in the room, if you want to use that term. It's the talk all across ag social media, ag Twitter, ag X, whatever you want to call it these days. The talk is that we're going to have a big U.S. corn crop. Now, we still have a little ways to go. We got to finish this thing out. There's been all the tassel wrap discussion and the pollination and more, but a lot of estimates are continuing to come out that are predicting and projecting a rather large U.S. crop. StoneX's survey Monday afternoon was 188.1. As you talk to producers, as you look at these data models, yield models, estimates, etc., I mean, what is your thoughts on what we are hearing and how it's impacting this corn market, Jim?
Well, right now, like you said, a lot of this is still estimates, obviously, folks. And, we can lose the crop, in late August, September, if the weather doesn't cooperate. But, so how do we look at the crop right now? StoneX did a survey of their clients. So theirs is the first, I'd argue, survey-based results, came in at 188. Pretty much everybody else, Jesse, is using kind of a yield model based on the crop ratings. Our cohorts in the commercial division, JSA, they've got a yield model that's arguing right around 187, just right in line with StoneX's number. And if you look a year ago in August, we're 1 week out from the August WASDE, the government raised the crop to 183.1. This crop this year, I think good to excellent ratings are about 7 percentage points better than they were last year at this time. So I think when you look at how this market's looking at for this number, do not be surprised if the average trade estimates come in closer to around a 185 crop. Now, the real question, honestly, within the industry is, have we priced in a 185 crop? I would argue we've talked about a 185 crop, but I would argue I don't think the actual economics of a 185 crop have been priced in.
And thinking about that, I know December corn, 402 on the close on Tuesday on the board, down a nickel. We're flirting with that $4 mark. I know old crop September's been in the threes for a little while now. I mean, what happens if we get a 185 national yield, Jim, or a 188 or something like that? We put in this large number, and you said it, it doesn't feel like that this is priced into the market necessarily. I mean, what could this potentially do to this corn market?
Okay, and the reason why I say the argument, the only thing into this is why people say it's priced in is, we've heard this 185 number for several weeks now, and the market for the most part has managed to hold the $4 level. That's where you get the argument it's priced in. My fear is why I'm leery to say it is priced in is, let's go with the 185 crop. If you leave demand unchanged, you just raise the yield to 185, roughly 4 bushels, that will essentially be about a 16 billion bushel new crop production. Our best guess, Jesse, is we've sold maybe 5% of this year's crop because the prices never really got there. When corn was at 470 in the spring, it was that 470 minus the basis was below break even for most clients unless they had these fantastic yields. So the crop was not priced. So now you've got about a 16 billion bushel crop. You may have less than a billion bushels price, which means you got 15 billion bushels of corn potentially sitting outside unpriced. Can we store it all on farm? Unfortunately, no. So some of those bushels are going to come to market. If you figure half can be stored on farm, That means you got another 7 to 8 billion bushels of corn that's going to come to market that we have not seen any hedge pressure to per se to see it. Because as a producer will be selling that grain, what happens is a elevator turns around and hedges it. And if you notice what the market's been doing, the funds are still carrying this massive short position. The farmer has been waiting and the industry has been waiting for the funds to get out of that short position to generate a rally up for the producer to sell into. What now seems to be going on, unfortunately, is essentially the fund ran out the clock in essence. We're harvesting in Texas, we're harvesting in Louisiana. So now what's going to happen, I fear, is as this grain gets forced to market, because A, the producer can't store it, B, he needs to generate revenue for fall bills, he'll be selling into weakness, and that fund will be essentially buying the dip over the next couple of weeks, and that could bring us down. Now, the next question is, how big's big? If you put the StoneX number in, that's a 188 crop. That pushes your carryout over 2122 potentially if you leave demand unchanged. And what's critical about that, Jesse, is that'll push your stocks to use to somewhere around 14.5 plus stocks to use. The 14.5 plus stocks to use is very critical because if you look historically in 2015, 2016, 2017, 2018, those years of just weak economic prices, what do they have all in common? Stocks to use in those years all were between roughly 12.5 and 15% stocks to use. So I think in a worst case scenario, if this crop is as big as StoneX perceives it could be in this survey, we still got a long way to go. We're going to stress it. You could see potentially another 50 cents worth of weakness if this crop is that big as we try to figure out where do we put this monster crop.
And I'm going to add something else in here too. You brought this to my attention before we went on the air, and I really hadn't even considered this thought, but take the talk of big potential U.S. corn yields, add in the Brazilian safrinha crop to that as well, and think about what that does to the overall world balance sheet. And I know that's just adding more bearishness upon bearishness upon bearishness here, Jim, but that is another caveat that I think folks need to put in perspective.
No doubt about it. I mean, right now, there's no doubt about it. You get on social media, the size of the U.S. crop, is it there? Is it not there? The warm nights, that is the debate that we're all having. But what's kind of been pushed to the back burner, in essence, is this monster crop out of Brazil. StoneX released a survey. Obviously, it got a lot of headlines here in the U.S., a 188 crop. But they surveyed their businesses down, and who they work with down in South America. Their crop, I think, is pushing closer to 139, I believe it is. But the net result, which is amazing to me, suggested if you take the USDA crop estimate in July and you take the StoneX crop estimate based on these two surveys, they're saying the USDA could potentially underestimate the world supply of just the U.S. and the Brazilian total crop this year by over 900 million bushels, which is just hard to fathom. It could be that much more grain being in the system than what the USDA has accounted for. Now, like I said, we will get an updated USDA number a week from today. We'll see where it comes in at. But, right now, when people want to go, why is the market not rallying? We are seeing great demand. I got to tell you, the corn demand has been fantastic. Bean demand's a different story. But why are we not rallying on this fantastic demand right now? Right now, the market is just focusing in on this supply situation. And I think that's going to be a wet blanket on the market till we get a better handle how big is. It could be the report on August, more than likely not. We do get the big field surveys coming in at the end of August. Last year, that helped out in the market. We'll see if that gives us a little bit more positive news as we transition through the month of August.
We can talk soybean demand here in a second, but I do want to tag on to our corn conversation. This wheat market has been a dog as of late, and I feel like, and I tend to believe that that's maybe acting as an anchor as well on the price of corn and maybe even soy as well. Your thoughts on that? Is this wheat market an anchor right now?
It is an anchor, and it's a dog with fleas, as some people like to put it. I mean, we thought this market had tried to bottom seasonality. We tend to bottom once you get through harvest. It looked like it, and now obviously we're taking out these lows. Now we are getting some down near some very critical chart support. If you look on a weekly continuous chart, both on Chicago and Kansas City wheat, there's been a lot of technical support around $5. hopefully that will be an area of support. If you could help stabilize the wheat, I do think that would help stabilize the corn market right now, because right now you're definitely, these two are kind of feeding on each other on the bear psychology, it feels like.
Jim McCormick with agmarket.net's our guest analyst here today on Market Talk. Let's take a look at soybeans. And, you mentioned how corn demand has been really good. U.S. New crop sales, export sales, last figures I saw a couple days ago, we're at a 20-year low, I believe. And China, to my knowledge, hasn't booked any new crop beans yet. That's another issue, I think, as well for this market. I mean, what's your take? What's your perspective on soybean demand right now?
Right now, it's a little bit scary. A year ago, this time, China they kind of ignored the U.S. for the most part. We got in a lot of part of July into August, and their sales started picking up. We have not seen it. And, I think there is some optimism, Jesse, in the market that maybe those sales will come. And that is allowing this market to kind of hold this $10 level. As we record this, it could change by the second. President Trump is still deciding if he's going to do the extension of a 90 days that was negotiated about a week ago. We'll see how he plays that out. But that, I think, is going to have a big impact on the price of beans. The supply of the beans, surveys suggest the bean yields are going to be just as stout as corn. But demand's going to be critical. What I'm watching right now is not necessarily the trade side, but the politics of it all. And what I mean by that is what President Trump is doing to India right now. They are putting a lot of pressure on India, partly because India is refusing to really cut a deal on the ag side. But the second thing is India has been buying a lot of Russia crude oil for the last couple of years as a cheap source of energy. President Trump is telling India, if you don't quit buying Russia crude oil, they're going to slap 25% tariffs on India. Now, that isn't a huge impact. It may impact bean oil a little bit. Well, what the real question, Jesse, is he going to use a strain strategy against China? Because China buys a whole heck of a lot of crude oil from Russia. So if he puts that same type of power play and tries to really, put the screws to China to quit buying Russia crude oil, is China going to retaliate by never buying U.S. beans? In essence, say there's enough beans to at least get them to the Brazilian harvest, kind of like they did in Trade War 1.0, I'd say. So there's a lot of uncertainty there. Now, the hard part about the President Trump negotiation tactics, it could change in a moment's notice. So we don't know where it's going to be, but I am concerned that politics could get involved in Trump literally trade, and that would be very negative, because the fact is roughly, I think, China takes up roughly 19-20% of our bean production every year in exports. So they're a huge part of that export demand. So if we do not get that demand here, it's a problem. The other thing real quick is if they would kick the can down the road, it's 90 days, which means maybe the first time Trump and Xi could meet, assuming they get along with the Russia oil situation, is the APEC meeting, which is October 31st and November 1. Well, if they don't sign a trade deal to November 1, that becomes a problem for the U.S. producer as well, because by November 1, we will have missed our window to ship beans to China, because you're right on the window for the Brazilians to start shipping. So there's a lot of uncertainty in the bean market, but one tweet could clarify it. So a lot of volatility ahead.
Yeah, great point. I do want to ask you, over in the cattle complex, we had a strong rally in both live cattle and feeder cattle futures on Tuesday. Here's a market where a lot friendlier tone than the grains. I know there's been some volatility, though, lately, and some worry maybe start to creep in here at these lofty levels. What's your perception of the cattle market right now?
Well, for one, it's not for the faint of heart. I mean, the volatility is extreme. Like you said, they're trying to now push the spot months up near cash. Cash continues to remain strong. But I am a little bit worried that you are starting to see the consumer start to crack. The jobs numbers, the revisions. I know there's a little debate on what happened, but the fact is those jobs numbers, if they're accurate, they're saying we're going the wrong way. The only sector of the economy growing is essentially healthcare. So we're seeing some cracks in it. I mean, I was just at one of the big wholesalers, Costco, over the weekend, and I tell you what, when you look at the price of beef compared to the price of chicken, compared to the price of pork, you do notice there seem to be a lot of people that were shying away from these expensive beef cuts. You got to understand, Jesse and folks, that is what the market's goal is right now. We have a very tight supply. So when you have a tight supply, the goal of the market is to get high enough to essentially crimp off demand, in essence, to ration demand. And that's what the cattle market's trying to do at the moment. We'll see if one thing we're watching on the politics side is, are we going to continue to slap that 50% tariff on Brazilian beef coming into the United States, which will continue to tighten that supply even more. But on the other hand, just like the grain market, if this crop is as big as it could be, then what happens? The market dives lower as a way to stimulate demand. So this market is trying to ration demand. But if you look at some of the economic indicators out there, it does look like we may be getting to a point to maybe at least some consumers are saying, I've had enough, I'm crying uncle, I'm moving to the cheaper protein values.
And to emphasize your consumer point, my wife and I were also at Costco this past weekend. And as much as I wanted some New York strips, we bought ground beef, but then we bought a big 12, 15 pack of pork chops. It just made more financial sense. And so to your point, it's an interesting dynamic to watch with the consumer at the grocery store right now. Final thoughts, Jim. A great conversation as always. Anything you would add or reiterate to folks on the show today?
Well, right now, like if you're in the livestock industry, I would argue, if you got profit margins in there, I would not be afraid to lock in some of these profit margins. You saw how quick this market rolled over last week, and it has come back. One of these times it's going to roll over and it will not come back. That's just the history of the livestock market. The grain market, there's going to be a lot of volatility. In the long run, I think you got to be a little bit friendly to the grain market down the line. But the next couple of weeks and months, it's going to be very choppy till we get a little bit of clarity of demand as well as supply. There will be brighter days ahead, folks. There always are. Cheap grain prices do stimulate demand, and that will bring the market up eventually.
Jim, I know folks want to reach out and have a conversation with you and the rest of the team and take a look at your intel and more. You guys have a lot of resources available there at agmarket.net, don't you?
We do. And the best way to get a hold of us is go to agmarket.net. Sign up for our research. We have a great app that helps you calculate your break evens. You can sign up for a free trial there at that app as well at the website, agmarket.net.
Jim McCormick, agmarket.net. Always good to hear from you, sir. Thanks for joining us on the show. Have a great week. We'll talk to you again soon.
Thanks for having me.
Make sure to subscribe to the Market Talk YouTube channel. You can watch our latest interviews with top market analysts in the country, find bonus content, and much more. It's easy. Just go to youtube.com/@MarketTalkAg and hit the subscribe button. Or you can search for Market Talk Ag on YouTube.